Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for October 19th, 2020. Please see our disclaimer for important information. We have a lot to discuss this week, a lot going on in the market. We're beginning to have some earnings reports, some good, some bad, and actually on balance, earnings reports that we've seen thus far have not nearly been as bad as we had thought they were going to be. But we're going to talk a little bit about China, perhaps, a little bit about the pandemic. And obviously, as we get closer to the election, there are still some more implications related to that I think are worthy of discussing right now. But just to kind of put a bow on it, what we're seeing out in the economy is that growth is slowing, but we do expect more stimulus and federal spending next year, which I think is probably going to help us stay out of recession. But having said that, and the data supports this very strongly, that volatility in the stock market is probably going to be embedded both directions, both on its way up and on its way down, until we get some clarity around a vaccine that is workable, that has demonstrable success out in the marketplace. But we've got several different influences on the market right now. The election obviously is not the least of which, and right now as we sit here today, there's a lot of speculation over whether there's actually going to be any kind of stimulus here in the offing for 2020. And I think the chances are roughly 50-50 that there isn't. Probably a little bit better chance that we have a lame duck session package that gets approved, or maybe even some latent hope that the package that might get approved next year will be a lot bigger than the one that's being bandied about now. But in any case, let's just kind of talk about the markets and then give you some observations, and then we'll dig into these kind of particular topics here. But basically, markets last week, Dow Jones was up 0.1%. The S&P 500 was up 0.2%. NASDAQ was up 0.8%. And this all comes amidst the rise in COVID-related cases in Europe. In fact, Europe, many other areas abroad are actually seeing a fairly strong second wave of this. And then even here domestically, we've had some rise in cases to the extent that even some boroughs in New York are actually shutting down and going to essential services. And then even in the market, we've seen 2 COVID trials for Lilly and Johnson & Johnson that were paused last week. But there's still a lot of liquidity sloshing around, still a lot of with these negative real interest rates that is driving more influence and investment into the equity markets. But so those are the equity markets for the week. For the month, S&P's up about 3.6, Dow's up about 3, NASDAQ's up about 4.5, and for the year, NASDAQ is up about 30%. What's really interesting in this is you look at the monthly data. This is again for October. The Russell 2000, which has been really kind of a stepchild in the market here as of late, was up 8.4%. Almost more than double, in fact, that of the S&P performance, even though the Russell 2 is still down 2% for the year. So, what's important here is that we're seeing a little bit of help coming into the small caps, and actually since September 23rd, the Russell 2000 is up about 13%, and the S&P 500 is up about 4%. So, and small caps typically respond fairly well to hints that we're getting more inflation on the margin. And even though the real inflation numbers that we're seeing right now are fairly low, there is speculation that a large spending package could drive inflation higher. But again, just looking in the domestic markets, we've got the New York Stock Exchange advanced decline line reaching new highs, and then we have more stocks that are trading above their 10 and 200-day moving averages, which is good. We're seeing better health in the market. we're not seeing this very narrow leadership that we did with those FANG stocks, those technology stocks earlier this year. And the fact that we've got small caps that are acting better is really exciting, frankly. So markets are beginning to focus on third quarter earnings in the election. We did see a lot of reports from banks, so in the banking reports, we did see several of these, JP Morgan, Bank of America, Goldman Sachs, trading revenues were certainly up. But a positive side note is that they put less aside for future losses. Their loan loss reserve ratios went down, but a couple of things that they did see fairly consistently: spending volume on credit cards went down, which I thought was interesting, and we're seeing more auto loans. So a little bit of mix there in the market. Also domestically, we saw some airline results, and this is just very consistent with what we've seen elsewhere. But the Delta, for instance, is burning through a lot of cash. United is burning through a lot of cash, and what they're saying is that it could take 2 years to get back to normal revenue, and that was very consistent with what we heard back in or from the airlines after we went through the global financial crisis. And then we've heard from some other folks like AMC Entertainment. Obviously, people are not going to the movies right now, and obviously the studios aren't producing the movies, or at least releasing the movies in theaters. So you've got many of these service-related businesses that are tied to entertainment, leisure, and activities which get people out of the house and get people, in closed indoor environments together, that aren't doing very well. And so there's a risk there that AMC might have to file bankruptcy. But in any case, looking across the landscape, the European, or the EFA, which is the international index, is still down about 8% for the year, was up about 1.5% for the last month. And then emerging markets are up almost 4% on basically some movements tied to the dollar, which a weaker dollar certainly helps emerging markets, and they're actually positive for the year. So, and then just looking at the Barclays aggregate, which is our fixed income index, we've already seen a lot of the heavy lifting, I think, in terms of return. That index is up about 6.8% for the year, but was basically flat month to date. And then high yield is up a little bit. Leveraged loans are still negative. But if you look at the dollar's still down about 2.8% for the year. Crude just holds very so steadily at that $38 to $41 a barrel range, and gold has just kind of found its a little bit of a plateau here at $1,900 an ounce. Gold is up about 25% for the year. Crude is down about 33%. And then 10-year Treasury is really holding still in that range. It picked up slightly over the last week to about 75 basis points, or 0.75%, which is kind of allowed 30-year fixed mortgage rates to kind of hover right around that 3 percentage point level. But looking at earnings season, right now, third quarter earnings are supposed to be about 20% lower, and that's actually an improvement over down 30%, which was expected literally 10 days ago. So the experience that we're seeing is better than what was expected. Now, we don't have a lot of companies that are issuing guidance. We certainly expect healthcare, technologies, consumer staples, and utilities to do the best, and energy is undoubtedly going to take it on the chin. But as we look out into fourth quarter, earnings are expected to drop about 13%. So we're narrowing that gap, if you will. Interestingly enough, we are talking about that narrow leadership. The good news is that we're seeing more distribution of performance across the index. The bad news is that technology now accounts for about 40% of the S&P 500. and that the technology was about this high back in 1999, and so even though we're seeing more near-term participation by other parts of the index, we're seeing basically the index performance year to date has largely been driven by these technology stocks, and Apple is now 7% of the S&P 500. So obviously what Apple does on a day-to-day basis is quite consequential for the index. So that's just a tidbit that's worth mentioning there. But the things that investors need to worry about, obviously we've got this uneven nature of the recovery. We've got a lot of zombie companies, or companies that really have no sustainability or getting funding. We have a fair amount of risk taking because of the liquidity, and we've got just kind of on a geopolitical side, we've got tensions, we've got differences in how countries are working through the pandemic, and then we have a lot of populism in not only our own election but other elections around the world. But what's another thing that I saw in the Wall Street Journal was really interesting is that individual trading really began to take off once all the brokerage firms went to 0% or $0 commissions, and that basically 25% of the shares traded in the U.S. stock market were in companies with share prices less than 5. That's 25%, and the normal range is about 10 to 15. So retail activity has accounted for almost 20% of trading volume this year, which is 2 times what was the case in 2010. And then we've seen just literally 10 million new online brokerage accounts have been created this year. So an interesting takeaway that we've got more retail investment in there, and these are investors that in many cases aren't nearly as sophisticated as the institutional buyers are. So we'll have to see how that contributes to perhaps increased volatility. Stocks pricing. Price to earnings ratio is 22 times. We've talked about that here before. The thing that it helps to prop up stocks, as I've mentioned several times on these broadcasts, is the negative real interest rates. When you take the nominal interest rates, the published interest rates, and you subtract inflation from that, those real yields are negative. So if you consider that, and you consider that the 10-year Treasury is at 0.75%, stocks provide a pretty good alternative, especially when that earnings yield of 4.5% and the dividend yield of maybe 1/3 of that is still significantly greater than what you could get on the risk-free asset. Just looking through some economic data, retail sales were up 1.9% in September. That was a third quarter bounce in overall economic activity that basically is puts us ahead of where we thought we'd be. Regional business sentiment indicators are continuing to post strong results. Industrial output was down, however, but that was mostly due to auto production and energy sector weakness. And then from a labor market, we did see jobless claims rise by 53,000 to 898,000. This is the highest level since August. So the labor market is beginning to, or not beginning to, it's basically the progress and the improvement of the labor market is definitely slowing, and we're seeing that in the data. Good news is that continuing claims, and these are claims for people that have been unemployed for a while, are continuing to edge down a little bit, and they're close to about 10 million right now. So that's a positive read-through, even if the current new claims numbers are still riding pretty high. But in any case, we have more speculation in the market. We have these blank check companies, these special purpose acquisition companies that are they're public only in name. They have private investor dollars, and they use these publicly traded vehicles to go acquire companies. And it's just a bit of a sign of speculation in the market, which comes at an interesting time because of the where valuations are. And it's just, if anything else, it's continuing to kind of re-entrench, or what's the word I'm looking for? Probably just solidify, or anyway, cement the valuations where they are right now. So, the good news is maybe retail sales the read-through on those might provide us a little bit of optimism heading in the fourth quarter. But if those of you who looked at our charts of the week and see that we're having a fairly consistent rise in the number of permanent job losses, and a consistent rise in small business closures, permanent small business closures. And so, even with that sales number for September, I think we should be very cautious on what's going to happen on retail sales and whatnot heading into the holiday season, which is typically the largest bulk of sales that we see. I talked about the labor market, talked about coronavirus cases rising in the Midwest here in the U.S., actually rising across the country, but rising especially in the Midwest and particularly in Europe, as I said before. We talked about earnings a little bit, stock prices. We've been obviously rising after kind of a choppy September. And this is really interesting because, this fiscal stimulus package, which has been kicked around like a total political football, there's no real consensus that that's going to get done. And I think, equity markets are going to be tested here coming up. We're kind of stuck in the middle here between this hope for a better, future in the economy next year, and, kind of some signals that we've got these rising coronavirus cases, and that, some of the economic momentum might be fading a little bit. And then, we know that the pace of the recovery is slowing. We know that policymakers are struggling to generate options to stimulate growth. And then we've got, aside from that, we've got political arguments and disagreements. And, I think the read-through on that is, you probably get the economy to kind of like, move modestly higher, to improve but not accelerate. And then, we just haven't had, with all of this unprecedented policy action, we haven't had a kind of almost a self-reinforcing expansion. And, I think when it gets right down to it, we're just going to have to see through to this vaccine and herd immunity case here. And from a stock standpoint, earnings will provide the mother's milk for price changes from here on out. I mean, I just can't see us getting infinitely more multiple expansion. It's going to have to come from earnings, and we know that earnings recovery is going to take a little bit of time. We won't have positive year-over-year performance until we get to the first quarter of next year. Again, so follow the medical news flow, and that will kind of help us chart the course for our eventual economic recovery here. So real quick, as we talk about perhaps interest rates and inflation, I think there's this thought that if we get this blue wave, and again, I'm in no way making a prediction, I'm just trying to be reflective of what could happen, but that the theory is that might help to push yields higher. Now, there's counter arguments to that, but if yields go higher, then prices go lower, then that's obviously not a good situation for bonds from a price standpoint. But at the same time, probably, with all the stimulus at the front end of the pandemic, people were worried a little bit about inflation. Yeah, and then we also had shortages and whatnot. We had stimulus money that was floating around. We're already beginning to see some disinflation on the margin. All you got to do is look at rents in Manhattan, and for that matter, rents all across the country. Not only commercial but also residential rents. We're seeing drops in medical care cost, and obviously college tuition is campuses are struggling to get students right now. And even those prices when we were in this kind of this crisis mode and everybody was crowding the supermarkets trying to get their hands on whatever they could eat, like meat and even appliances and things like that. Many of those prices are coming down as well. So, even with, this, thought that we could get inflation from all of this stimulus money, or excuse me, all of this fiscal activity, I think it's fair to say that I think the transmission is going to take a while because clearly we have some disinflationary forces at work right now. But having said that, then you've got Biden out there that is talking about raising corporate taxes, especially on individuals making over $400,000. They could get a really big tax increase. You could get estate taxes that could rise, as well as Social Security taxes. But if you increase corporate taxes, that could in theory push some investors from stocks into bonds, which would drive prices higher and drive yields lower. So I think there's there's just some cross currents right now that we're just going to have to let play out. There's no clear path to whether we're going to get measured inflation or what's going to happen on interest rates. And and long-term interest rates are going to be influenced by expected inflation, and that's a big question mark right now. And the thing is, if you get a blue wave in here and they want to be activist and want to do a lot in year one, you could choke the economy in this very nascent recovery. Remember, I just said that I feel pretty strongly that this economy is just at best going to kind of grind higher, if you will. And if you do something to kind of put a strangle on that, then you could see the economy just kind of stall out. You could see stagflation. Then that would be a problematic environment and certainly wouldn't lend itself to any kind of inflation anytime soon. But I think we're going to know a lot more here in about I think 30 days, 45 days, hopefully, and hope we don't get a big conundrum here with the election. But so real quick on coronavirus. I talked to you about cases rising. You probably read some of these things, but the European territories are really seeing a big rise. Schools over in Europe are getting a lot of cases. Recording an average of 78,000 cases per day over the last 7 days. And this is kind of coming a little faster than I think a lot of people expected. Here in the U.S., new cases are at their highest level since mid-August, even if the death rate on a relative basis is going down. But we've got new cases that are above 50,000 per day. The 7-day moving average is higher than the 14-day average in more than 40 states. And we're getting more transmission in rural areas. But, it's kind of, just, compound the problem. I mean, people are generally pretty tired of restrictions. And you've got a lot of people that are easing mask restrictions, or just people that are defiant, not wearing masks at all. And we're heading into the cold weather season. So to all of you, I say, please be vigilant and get your flu shot for crying out loud. That's the least we can do. But the poll in the Wall Street Journal said 27% of people don't want to get a vaccine, and 50% only want to be vaccinated after waiting for some period of time. So when you add all this stuff up, you've got a pretty significant, you know, um, cost associated with this. I mean, you may have the International Monetary Fund said that, um, the governments have committed about $12 trillion or 12% to global GDP from the stimulus that they put in and the response. And central banks have purchased 7.5 trillion of securities, and that despite all of this, the world economy is going to drop about 4.5% next year, and that if and this slide is in my charts of the week pack, and that we're going to have 100 million people fall into extreme poverty, and that's like earning less than $1.50 a day. That's very significant, and I think that the second order effects of that are going to manifest themselves in social unrest and some other problems that we're going to see fairly soon. But and COVID probably going to cost us about $16 trillion all told, and that's 90% of GDP, and that's basically all of the associated costs of what we're talking about here, loss of life, economic damage, so on and so forth. Our deficit is going to continue to rise. The federal government had a $3.1 trillion deficit in its latest fiscal year. That was 16% of GDP, which is the largest deficit that we've seen since 1945. And federal debt held by the public reached 21 trillion, which is 105% of GDP. So, I think there's going to be a real battle to be fought next year, even though I do think spending is going up, but you're going to have a revolt by the people that just, cannot see through to modern monetary theory, which is the idea that if your interest rates are at zero, you can just continue to print money till there's no tomorrow. But this is going to come to a head at some point, and it's going to be something that we're going to be talking about for a long time, getting our fiscal situation back in order. But having said that, the last thing I want to mention real quick is China. And the word about China is that they're going to be the only major economy in the world to grow this year, probably about 2%. And they just announced that the economy yesterday grew, or excuse me, over the last quarter grew about 4.9%. And if you take out China, then you're going to have negative growth. And I still think there's a possibility that we have global negative growth, especially as the International Monetary Fund has already suggested. But so China has certainly benefited in their export economy with having a weaker currency. I think they are, by all yardsticks, manipulating that. There was an article in Barron's that talked about that over the weekend. That even though, one thinks that they've reduced their foreign reserves of foreign reserve holdings of treasuries, essentially holdings of U.S. dollar denominated assets, it appears that they're moving those around to state-owned enterprises, and so that's not really the case. So Chinese still continue to hold the bag on a lot of U.S. related debt, and so unfortunately that's not necessarily the best place for us to be, but we've got to work on ourselves first before we can, I think, be very belligerent on the trade front. So in any case, just some thoughts, some cares and concerns. We had a lot to talk about. I think we'll need to be very mindful of the economic data, particularly on the consumer side, because there are business closures, permanent job losses, things like that we're going to need to be aware of. Small business closures and capital spending, even though those numbers are looking a little bit better, we'll have to make sure that those continue to follow through. And earnings, we're not going to get a lot of guidance coming out of the market And the good news is that some of these earnings reports are better than the really awful reports that we were expecting. So we'll just have to continue to, or begin to anticipate what the first quarter, or excuse me, the fourth quarter of this year and the first quarter of next year are going to look like. And also hope that for small businesses' sake that we get a stimulus package follow-on here before too long, and that people can honestly just push politics to the side and come together for the good of small business. But with that, that's really all I have to say right now, and we'll move on to our next week. Please send us your comments or your questions. I'd be glad to answer those at the information you see there. Have a safe week. Be careful, and we'll talk to you again soon. Take care. Bye-bye.